Alastair, you and I have known each other for a number of years. I've always been ultra impressed with your wisdom. You're a brilliant entrepreneur, businessman. You've launched many businesses, great success. You have a journey from Zimbabwe. You've experienced hyperinflation, probably one of the highest inflation in the world. And you have a unique perspective from the world. One of the first things that I really learned from you was that the Fed always follows, they never lead. The markets lead. And you've had great success with dental businesses, veterinary businesses. So I want to stop for a second and let you take over. Tell us a little bit about what's new and exciting in your world. Obviously, we'll jump to the new administration, Trumponomics. What does it all mean? But before we do that, any quick comments on what's new and exciting in your world?
Yeah, well, it's great to be here, Mike. It's good to be with you both. Certainly, there's a lot going on in the world, and I have the luxury and sometimes the burden of living in multiple worlds, from European interests to African nonprofits in really remote areas, to businesses in Canada and clients in business in the United States. So, and the reason I say that is the repercussions in the last few months around everything from geopolitical shifts to tariff impositions, threats, and withdrawals, and so forth, are affecting every single one of my interests. They're showing up in different ways. Interestingly enough, with just a matter of different degrees of severity, the complete folding of USAID, for example, is affecting has a massive amount of influence on my nonprofits work in Central and West Africa. We don't rely on USAID for funds, but we're seeing the fallout on the ground of some of their programs there. European interests, of course, and my fellow board members and so forth, are very much caught up in their own political turmoil, both in reaction to what's happening in the US political system, but also from their own turnovers. We're seeing global turnover of kind of hierarchies in all power structures around the world. And then, of course, back in the United States, just a much anticipated rise in quote unquote uncertainty, which is really to say individuals coming to terms with the reality that we can no longer count on previous models of business, product, sales, thinking, or expectation. And the severity of the pullback that we're seeing in equity markets, the tumult in the bond market, the muni bond market, is right back to where it was in value levels of a year ago, or just in a few weeks. So, yeah, there's a lot going on and lots for us to discuss around the implications.
Thank you, Alastair. And yeah, that's on everybody's mind. You just shifted into the main conversation. So you have a global macro view. You're connected broadly, and I guess U.S. is impacting the rest of the world in a huge manner, and it's part of the strategy. Part of Trump's strategy is to change, is to make America first. I guess that's at least what he publicly says. But change is very disruptive. Normally, preach a lot of change one thing at a time. With Trump, it's preach a lot of change a lot of things at a time, create ton of uncertainty. Let's start with trade. First of all, business can't operate, or very difficult to make investments and make decisions when you don't know what's going to happen tomorrow. Tariffs are on, tariffs are off. What rate? When? What's going to happen? How do that part of Trumponomics going to settle? So we see ton of volatility and uncertainty today, and it'll continue. It's the new sheriff in town, new norm. When and how we settle, so we can proceed predictably. This is on a lot of people's mind. We're chatting. I had discussions with very, very prominent folks over the last couple of days. Nobody knows. Everybody's nervous. Everybody's concerned. It's to the point these corrections in the capital markets are becoming to be painful, and people they're very concerned, to say the least.
They are, and I think it's indicative of where we are in the cycle. We are late cycle in this expansion that's really been unrelenting, barring the bizarre COVID period. It's really been an upward trend in all asset classes since the lows in '09 and 11 in equities and the Case-Shiller index. So the response is indicative of where we are in that cycle, which is to say, one of the most predictable late cycle phenomenon is that individuals are all in. People have extended leverage. The most they tend to take on debt. At the end of in this case, 15, 16-year booming market in multiple assets, the instinct is to just extrapolate what has happened into the future and call it a forecast. This is really common. And it works to the extent that the trend is not changing. But when the trend changes, we get to see the difference between full and half cycle thinking, full and half cycle business model, and full and half cycle, what I refer to as full and half cycle investors. One of the most predictable phenomenon, once things have gone so well for so long, excuse me, as I mentioned, this linear extrapolation. Yes, it's gone well, but it's going to get even better. That's
I'll
really
add
what has been
one
going.
comment. It's called recency
Mhm.
bias. People
Yeah,
people think that the trend will continue, and when it breaks, that's what we're seeing right now. It's exactly what you're saying. The recency bias has
exactly.
been dominating. People have been too complacent until the cycle peaked, and you're a little bit too late to the train.
It's exactly right. In this case, it's particularly pernicious because the recency bias of the last year, 2 years, can be extrapolated out for the 16 years. So it makes it even harder for us to believe that this new data is anything other than bizarre, anomalous anecdote, meaning that we become more and more rigid in our thinking, our expectations, our business models, and so forth. And so this manifests itself in extended leveraged optimism, where people start to take on more debt, they buy bigger homes, they expand their businesses, but most critically, as we're seeing in the investment markets right now, they completely deplete their reserves because they haven't needed reserves for the longest time. This is, as I say, particularly insidious and tricky right now because one of the largest trend changes that nobody is apparently willing to talk about is the fact that long-term interest rates bottomed 5 years ago now and have been in a four, depending on which rates you're looking at, 4 or 5 year upturn. This means that so many of the bull market habits and safety net, one of the most important one, has gone away. And that is the ability to refinance out of bad decisions, bad assets, bad business partnerships, etc. The opportunity to, if we can make really bad decisions, and even if we're not being compensated, we get a bailout of lower rates, being able to repair our balance sheet. That is gone. And it's been gone now for four, and again, depending on what rates you're looking at, the 2 year, the 10 year, wherever on the yield curve, 4 to 5 years. So we've extended, we're at record levels of leverage in terms of in most investment companies, record low cash margins in both households and mutual funds. The mutual fund cash reserves is lower today than it was at the all-time peak in 2000 and lower today than it was at the next peak in 2007, sitting at about 2.6%. That mirrors the same cash reserves or savings rate of the average American today, 2.8, 2.9%. What this means is that individuals are all in on whatever philosophy brought them here. This is tricky because, as I say, there's no margin of error. Coupled with that, the vast bulk of investors have come, as they do, especially the less sophisticated investors, are late arrivals into the marketplace. These are individuals that are paying maximum dollar for real estate right now, that are buying Bitcoin at 100,000 per unit, that are buying the S&P at 6,000. These are the individuals showing up the latest, paying top tick on assets with no room for error. If we contrast that with where, and so I consider this to be extremely precarious situation. By contrast, we look around the world and say, what place is sitting in the exact opposite? What culture or region of the world has a 26 instead of 2.6% savings rate? What culture or economy is at the end of a 17-year bear market instead of a 16-year bull market? Where are we seeing constant pessimism and concern that this particular part of the world is only going to get worse while we're sure here that everything is going to get better? Looking at, for example, the Economist magazine cover as a great contrast of the two. Well, I've just described China. Very, very different profile in terms of risk and opportunity in my mind. So there's a lot of things going on here. We've had a change in trend of interest rates, apparently a change in trend on equity prices, bond market performance. We've finally seen in the last 18 months a bifurcation between rates on the short end and the long end, as you and I have discussed many times. So a lot of large trends are changing. And it's kind of Schopenhauer's three stages of truth. First, it's considered ridiculous. I'm paraphrasing. It's considered ridiculous. Second, we consider it, possible. And finally, we consider it self-evident. These shifts are still moving from stage one to stage two in these new trends.
There's a lot to unpack there. So the great wisdom is the stock market, crypto, number of other asset classes have been at the peak of a long cycle, and the reversion to the mean, the laws of that basic economic gravity is pulling them down. I actually presented a little early in the week, looking even at S&P 500, looking at the dividend yields, looking at the PE growth, and things look very significantly overvalued, overpriced relative to the intrinsic value. And it's been really based on a lot of optimism that the trend will continue. And the moment the trend breaks, obviously, we see what we just saw recently. But let's continue the conversation. We'll go back with the Trumponomics. So one of the questions is when things will stabilize, or maybe they won't stabilize for a while because we are due for recession. And recession, I think Fed of Atlanta was projecting negative 2.4% for Q1 GDP growth. We'll Q2 might follow. We might actually hit a technical recession this year, right? That's a possibility. So what are your thoughts on obviously US GDP, US unemployment, overall inflation? And then we also looked at data last year. US was leading the world. Dollar was up versus pretty much everything and up significantly. So will the dollar strength continue with Trumponomics? Maybe a great opportunity in China, but function of the return is an exchange rate too. So where we go on the exchange rate with China, and we are primarily a U.S. investor. So where do you see opportunities in U.S.? This is the other question: is you may be looking at the global, and some folks are comfortable to invest in China, some are not because of the obviously political regime. And one of the reasons people love to invest in U.S. you have laws that protect investors. In China, you have to be fairly well connected and protected over there, otherwise, any day of the week, the government can knock on your door. So it's a little bit of nerve-wracking, and I think this continued to move the capital out of China into other markets, not because China is not cheap, relatively speaking, because it doesn't matter what the return is that the government can take it any day of the week. So back to the U.S. Trumponomics, trade wars. Are we going to get any stability anytime soon? You think? Just an opinion. You may be wrong. This is a very difficult thing. And then impact of immigration, fiscal and regulatory policies. Just quickly, sort of, where do you think we're going to shake out for the rest of the year, and really looking for the impact of inflation, GDP, unemployment, and what are opportunities to invest? The billion-dollar question: where do you write a check if you don't want to go to China? If China feels like something that politically is a little concerning, can you invest in the United States? Where do you see opportunities? My opinion, and I'll shut up, is that commercial real estate that has already gone through a very significant correction in the last couple of years with the higher for longer interest rates presents, on a relative basis, great buying opportunity if you can find those deals, because the interest rates have pushed the cap rates higher, while the overall inflation continue to push the rents higher, depending on the market, of course. Some markets vary. But on a relative basis, at least in the US, we see opportunity in the commercial real estate because 25-30% corrections has already taken place. Can it go down more? It could. But at least it's already a well discounted valuations relative to the current rents and relative to the future projections. And the most important thing in commercial real estate that I really love, just love to hear your thoughts. When we can find a deal with a positive cap rate spread, what you pay, it's called 9 cap, and you borrow the money at 7. That's 200 basis point spread. If you can find a deal like this, it feels pretty defensive. And in the past, all these spreads were very negative. So today, if you can find a deal like this from a motivated seller, I see opportunity. I'm going to shut up and stop and just kind of go back to some of the questions that I know it's a lot of questions, but take it wherever you want to take it from here.
I think the internal workings of your and my mind are equally chaotic. So I was following you the whole time. We're all over the place. First of all, in reverse order, I think that credit spreads have begun to widen, and by the time the cycle is complete, they'll be at record levels of widening. So that's a trend that is just beginning. With
High quality credit versus the junk.
Versus junk, yeah. And the breakdown in junk really in the last 48 hours is evidence that this is more than just an equity market pullback. This is starting to percolate into the debt markets. So the strategies like the one you identified, there's likely to be more of those going forward. Of course, one has to be very careful. An asset that falls 50% can fall 50% many times. So we need to be very careful about catching falling knives, I think. But like you say, I mean, just this morning I was looking at data in Atlanta. 26% of commercial office space in Atlanta is either empty or for lease. According to CBRE, further fully 19% of commercial spaces in the greater metro Atlanta area are in some form of default, 30, 60, or 90 days. So
that's office, right? We're talking about office.
Office, yeah, sorry.
Yeah, office is still in dire straits. Office is difficult to see when it's going to start recovering.
And we're looking at an administration that's looking to offload as much as 60 million square feet of government space here that's just sitting idle, that's costing the government 430 million a year just to maintain. And that's before we even get to any sort of layoffs. So as I say, it's tricky because there's a deluge of potential supply stacking up on top of an already depressed asset class or weak asset class. So office is definitely on the front end of the spear there. And that's with unemployment turning up. The SARM rule was triggered in the end of Q3, beginning of Q4 last year. It has a track record of anticipating recession impeccably. So we have to take these things seriously. But to the point of, safety of capital and abusive leverage and deployment and political manipulation of the regulations in administrations in Asia and so forth, it's worth pointing out some of the things that are coming to light is we've been doing the same thing here in the United States. Complete suppression of individual sovereignty, of social media panels and platforms. Europe and the UK, you can be arrested for what you post on social media. The Dutch and the Germans are very aggressively policing private, or rather private individual rights to free speech. So this is a global wave that is really, it's another conversation, but this is something that we need to really respect. And the current administration is no stranger to lawsuits and willing to do things just in the last 3 months that apparently test in the eyes of some the laws themselves. So I think that's in a new bull market. Let's put it that way. Legal acrimony is only likely to escalate. I think one of the greatest risks, and I just say this not as a hedge, but because it's true, one of the greatest risks is for us to fall in love with our individual economic or political deity. It doesn't matter whether you're red or blue. There are multiple players in this game. And so the idea that any one person is going to save us or one person is going to destroy us, it's just not the case. It's worth reminding ourselves that in all of Western democracies, the US president is oddly enough one of the weakest. And I think that that's one of our saving virtues. There's a lot of work still to be done to make any sort of massive change outside of the shock and awe campaign. And I think that that's a good thing historically. But to come back to, you mentioned another thing, currencies. I think that the yuan and the renminbi is grossly undervalued, and I think that it's likely to begin a strong bull market here toward year end. I think that the yen is probably the cheapest, most undervalued currency on the planet right now. Having said that, I own a position counting on this. Not necessarily talking my book. This is just a trade I've made in the last few days. I'll be building on that. But again, as you say, I have more of a global take. I'm kind of border agnostic. I don't really care where it is as long as it fits my buy box. And that's the tricky thing. One of the problems with late cycle phenomena or late cycle environments is this phenomena of individuals loosening up their discipline, where their buy box that used to be this big is now this big purely because they can't find opportunities that math for them. And this is something we need to, so there's never been a more important time for investment discipline than now. And I think one of the best examples of that is Warren Buffett. Warren Buffett is one of those people that we all love, and we all love what he says, but he doesn't do what he says. Which is to say, he doesn't do what he advises others to do, which is essentially just own a basket of the S&P at any price, hold it in perpetuity, and don't ever try to sell something because it's overpriced. Yet, in the last 6 months, he's offloaded a massive position in Apple, almost calling the top in Apple, another one in, Bank of America, and is now sitting on as a percentage of assets, the greatest cash reserve that Berkshire has ever held in its history. So, it's not what you say, it's what you do. It's worth paying attention. And if all we did was just mimic that aspect of Buffett's decision-making around valuations and sat on the equivalent 35% in T-bills, which in the case of Berkshire is so large. Berkshire is currently sitting on more T-bills than the Treasury itself. That's when you know you're a big fish. Let's put it that way. So there's a lot there that you pointed to in terms of identifying opportunities. Again, the discipline of your buy box is going to be crucial. Equally, to the extent that interest rates truly have formed a meaningful multi-generational bottom in 2020 and 21, which I maintain they have. In fact, you and I were talking about this in 21, that I think the larger trend is up. To the extent that we are now in a bond bear market, notwithstanding some strength in bonds through maybe the next 6 months as a recession rolls in, if the larger trend continues to remain up, then what any smart bond trader would do, or bond holder, is shorten duration. And we're seeing that. We've seen it in the yield curve. Even right now, the yield curve is essentially flat. From 90 days to 10 years, it's essentially at 4.29, 4.31. We've got a dead yield curve, signaling that shift and that balance between individuals not wanting to overcommit for concerns of inflation, but at the same time, not wanting to commit too much to equities and continue to shore up cash in short-term T-bills, which of course Buffett is doing himself.
I got you. And one question on this front. So that makes a lot of sense. People are parking cash in short maturity treasuries. Seems to be maybe up to medium term. A year or two is probably as far as people are willing to go, and the yields obviously have reflected that. But what's the forward outlook on inflation? The Trumponomics, Dodge, some of the things that Trump is doing, they can put us into a recession, and that could be deflationary. Obviously, reduction of the size of the government is substantially deflationary. Global trade war is unclear. They could be inflationary in nature, but there could be also compensating factors. And then you've got overall slowing U.S. growth, maybe global growth. So these things should be meaningfully deflationary. So the interest rates, maybe in the short run, a couple of years, at least at least what I'm seeing, is sort of looks like we're in a potentially declining interest rate environment. The Fed has signaled wait and see, but they're still on a cutting sort of a journey. They're not done yet. If you follow Fed theory of what they're trying to do, the interest rates are still meaningfully restrictive, pretty restrictive. If you have a sort of a balanced environment, the the Fed funds rate, depending on how you look at it, maybe long maturity bonds, they should be above the inflation rate, but not above by the way they are right now. Inflation is hovering around three. If it drops below three, the Fed funds rate should be what, 50 basis points, somewhere above that. We are still 150 basis points above where we need to be in theory. So it feels like the policy is pretty restrictive. And then at the end of the day, you mentioned this earlier, and it's on a lot of people's mind. Maturity's cliff. A lot of paper matures, and interest rates were at the bottom. Let's call it early part of 22, and the rates have climbed since then. Since then, meaningfully. So the point is, a lot of paper comes rolling, corporate bonds, even mortgages, commercial mortgages. What happens? Try to refinance right now. You borrowed. Give you example. I have a property with borrowed 10-year fixed mortgage, commercial property, 2018. 2028 looks scary. At least it's a number of years away. But if we had to refinance right now, it'd be incredibly challenging because the rates are meaningfully higher. So it's the property itself has to support high NOI in theory, but the cost of money is up so much that if the Fed doesn't do anything about it at some point, it's going to cause serious, I guess, price devaluation, right? It's just what happens. So it's in theory, it's already happened. If you were to put the property on the market today, a lot of these values have adjusted to the high level of interest rates. So I'm just curious, what do you think about inflation? Are we going to be in a at least short-term deflationary environment, slowing inflation, or it's a stagflation, a form of a stagflation, slowing economic growth, sticky inflation? What do you think, and what should investors do about it? At the end of the day, you're mentioning some of the opportunities that are global macro, buy yen, buy maybe Chinese bonds, or if you're comfortable, be in equities. And then on the other front, what are the best opportunities here in the United States besides cash? I'll add one more comment. So Warren Buffett, he's do as they do, don't do as they say, because he can afford it. This is the biggest wisdom is he's always been a very patient investor. He doesn't have to rush. For majority of investors, it's this conversation, a little conversation yesterday. My parents, they're in a nursing home, they got money, they need income, they need to be invested. They can't be sitting in treasuries, not enough. And then they wind up actually losing. They wind up losing because they're in the market. So I don't know if people actually go and pull the money out of the market, and the markets get more volatile and move the money into treasuries, maybe short maturities. Probably a lot of people are already doing this. So I'm just curious about inflation outlook, and then is it going to cash, sit and wait, and wait for what? For what kind of correction? For what kind of adjustment?
The overwhelming, my thesis coming into this year, shared with my clients at the beginning of January, is for all measurable, reasonable valuations and expectations, what you pay for an investment dictates its return. When we look at it as a stream of future cash flow. So we know this. We know that, if I buy a property, two properties next door to each other, one, they both have a cap rate of 12, the person pays $1,000 a month, and I pay $100,000 for one, and then I come back a year later and pay $200,000 for the one next door, I've essentially halved my return by overpaying. So this is simple math. Everybody knows this. And I say this because the Wall Street sales machine is one of the most intellectually bankrupt and morally bankrupt on the planet. I know, I worked there. Is everything, anything that doesn't align with a narrative is in some way needs to be poo-pooed. And the best example of this is the talk of making changes, as I've recommended for my clients coming into actually as the year was ending, is making large shifts from US-based, US-centric to emerging markets. The cynicism and self-preservation narrative out of Wall Street is, oh, your market timing. It has nothing to do with timing. It has to do with price. If I get an opportunity, Hong Kong, for example, you can buy Hong Kong businesses for 70 cents on the dollar, meaning that you buy $1 worth of book assets for 73 cents. That's astounding. That's astounding. And it assures you a level of security and safety. And I'm not necessarily recommending Hong Kong, though I own it. I'm saying as an example of valuations dictating future return. Again, coming back to the original point of being disciplined about what qualifies for our money, in the same way that I maintain we need to be disciplined about what qualifies for our attention. In a world where we're awash with unnecessary information, very little of it is of any use. We need to become discerning, we need to become disciplined about where our attention goes. Same with our capital right now. So on the macro, I believe that we are shifting from a digital and US-centric equity market for the last 15, 16 years into a hard asset emerging market narrative for the next decade. And I mean generational opportunities in emerging markets are finally presenting themselves, in my opinion. I say this just as a contrast of overpriced versus underpriced on the mega macro level. Having said that, this implies inflation is inside of a much larger cycle of rising. But this is where we get it, the nuance is important. When we say I'm expecting inflation or I'm expecting deflation, we inside of that statement is actually a time forecast, which is when are we expecting that? When and in what sequence? For example, it is my conviction that the larger trend in inflation is up. And it is also true that between here and inflation being the biggest risk, I don't think it is the biggest risk. The biggest risk is, as you alluded to, for all of the reasons that you did, widespread asset deflation, specifically debt deflation. When we look at the amount of really criminal activities that have been going on in the FHA, for example, for the last several years, beautifully revealed in a piece about in the Wall Street Journal just a couple of weeks ago about the dysfunction of the FHA, whereby approximately 63% of borrowers are above the magic 43% debt to income rate. These are individuals that are effectively in default. It's just a matter of when. Equally, fully 400,000 FHA loans are in serious default. And this means, of course, they're beyond 90 days. These are individuals that, in most cases, defaulted within the first year of ownership with all of the government incentives to make home ownership, quote, more affordable. All that it's done is make it less affordable for others because we've put this artificial floor under the lowest income earners and never kicked them out. That's 400,000 homes that have not been allowed to move from default to foreclosure. If that were to happen, that would increase the national inventory of homes for sale by as much as 30 to 40% overnight, if that were to occur. The issue, of course, is Trump and Musk are talking about doing exactly that, about cutting excess and ridiculous bailout programs everywhere. Should they turn their attention to this, this could have massive impacts on valuations of assets. I use that as an example. I recommend it. I think everybody should pull up and look at the Wall Street Journal. It's something about Biden's home ownership plan, whatever it's called. It's worth your attention. And I think it's bold and accurate reporting. I say this because all of this points to the real risk. Long-term is probably inflation, but between here and when the long-term begins is asset deflation. We're already seeing it in equities. We're seeing it in muni bonds, in junk bonds. And I think that we've got to get through that, which means cash is still, in deflationary periods, we move into a strange environment where cash is actually king. Going forward, the inevitability of this flow of debt being deflated and then a credit cycle expanding again via more government boondoggles, I think we can expect to see inflation around the world. One last point on this. This is worth considering because it dovetails into the same macro issue that we've been privileged with from 1981 to 2000 to 2021, which is essentially this giant 40-year bull market in bonds and bear market in rates. Rates were consistently falling, which gave us rising asset prices and falling commodity prices. As capital became cheaper, more and more third world economies were catching up with our capitalist system, and we saw a massive influx of commodities coming in at record ever cheaper prices from Brazil, Asia, Africa, and so forth. Excuse me, that ended on the macro level in 2003, 2004, but really since 2021, we've seen a meaningful uptick in the commodity markets after a pullback that I think is still going on, meaning that from 1981 to essentially 2020, we experienced asset inflation and consumer price deflation, where devices got better, and then the technological accelerants behind that. Devices got better and better and never cost us any more in nominal terms. Meanwhile, our homes and our portfolios and 401ks and our businesses were consistently worth more and more, giving us incredible returns and extremely lazy investors, voters, and business owners. Epictetus said, full bellies make empty skulls. And that's exactly what we've become. We've become lazy in the privilege that we've enjoyed of globally imported deflation in cost of goods and our homes and groceries, which is ending now in the last few years, and rising asset prices. Should we find ourselves in the exact opposite environment where assets deflate and commodities rise, that will feel like what you're alluding to as stagflation. But this is not going to look like the stagflation of the 70s because of this global commodity phenomena that was not extant in the 1970s. Equally, though we were coming off of record highs in 68 and 69 in asset prices in the US, we were nowhere near the valuations that we are today in terms of valuations of US equities and valuation of homes relative to a person's ability to afford them. The gap between renting and home owning now is larger than it was at even the peak of 05 and 06.
I have a quick
Lots.
question.
Go
Sorry.
ahead.
So what sectors of commercial real estate do you think are well positioned for growth in 2025?
That's the critical question. But real estate is really an arbitrage game, meaning that we get to take advantage of locally spotted inefficiencies. I don't know of any sort of macro thing outside of these areas. Should the FHA rug pull happen, you'll see real trouble in areas of the greater Atlanta area, which is a lot of them, greater Dallas area, and outside of Phoenix, and some parts of LA are the ones most at risk for this potential FHA boondoggle being terminated. That means opportunities will have to be in those areas will be on the other side of that. But what this means, I think, is I don't know that there's any one particular sector within real estate that looks super attractive, which means to the whole thesis that I share and teach is the full cycle investor is able to adjust their model to capitalize on opportunities as they present themselves. Whereas going into 2020, 2021, you could buy pretty much any real estate and it was going to work out. We now have to have disciplined, qualified, full cycle investors that are shepherding capital to spot the opportunities. To answer your point more specifically, Deanna, this is going to require a seasoned person with a sharp pencil and real discipline to spot them. And where they find them, I'm agnostic, to be honest. I'm agnostic.
Yes, but it's a precision. It's a precision surgery, not throw a bunch of stuff and see what sticks on the wall, because those times are gone. You have to find a deep value and be convinced that it's a great investment relative to its local and specific characteristics. Let me continue, and then maybe Diana, you can chime in with another question. So you mentioned commodities, just thinking through the process a little bit. And that's an interesting observation. What about these two commodities? Well, gold, precious metals. It has had a great run. 24 was just an insane run. Relatively speaking, it's up from almost level 2,000 to 3,000, plus minus a little bit. It's a massive bull run in 1 year. And then energy, oil and gas, that typically fluctuates quite a bit with supply demand. So I'm just curious if you have any quick thoughts on the energy sector. It's a commodity, form of a commodity, right? But it's a specific commodity because it is driven by the supply demand, and then precious metals. Any quick comments on that front?
I've been very bullish on precious metals for the last 3 years. It's been very rewarding. I still am. The new highs this week are evidence we had a breakout above 3,000. I think that ultimately we've got this run still has legs. Silver, oddly enough, I can pretty comfortably make the case, is the cheapest asset class on the planet. It is the only commodity or asset class that is below highs of 1981. I mean, that's how far away the silver peak was. Astounding. Having said that, not necessarily as much a fan of silver, though it has got some, it has some accounting to make up for its gap between gold and silver. Platinum as well. I've been waiting for a number of years for platinum to close the gap between the historic premium that platinum traded at over and above gold, and that premium continues to just turn into a discount. It's been woefully underperforming.
Can I stop you for a second? Yeah, on the platinum front, you're an active trader. I don't follow. I invest in gold and silver. And gold has done really well, and silver has been on a relative basis. I think the ratio between gold and silver is very bullish to buy silver, sell gold per se. But platinum, I looked at recently, and I haven't followed it. I was almost shocked how much less expensive it is than gold. And I remember the times where platinum was way more expensive than gold, and today per ounce, it's lagging. It's shocking. It's a shocking. I don't know if it's industrial use or what. For some reason, there's a disbalance there.
Yeah, and it's interesting that the story behind platinum, the fact that it's historically traded at a premium to gold, now it's at a massive discount, the fact that the largest stores of platinum are in tumultuous political countries like South Africa and Zimbabwe, my home country. All of these stories should be supportive of an absolute ripping bull market in platinum. But those stories have been true for 5 years, and they've been wrong for 5 years. It's a great example of we can do all the analysis in the world and use every possible historically accurate precedent and still be wrong. So having said that, I'm sure at some point platinum has to pick up a bid. I've started accumulating more positions in platinum, but nowhere near as bullish on it as I am about gold and silver.
Energy.
Energy, yeah. I think that energy is I'm not bullish on oil, oddly enough, and not just because of fundamentals such as, we're already seeing Delta Airlines, United Airlines pointing to the fact that they're seeing a cliff of drop-off of demand for flights, which makes sense. Coming out of COVID, everybody was awash with PPP money and ERC money, and we saw a spike in not just travel to foreign countries, which Americans don't typically do as much as the rest of the world does, but all luxury travel, business class booked out, fanciest resorts around the world. So we're on the other side of that correction as well. Evidence of the consumer discretionary purchases being pulled back. So I'm actually quite negative on oil in the short term. And I think gold really, the whole store of value stuff, it's worth pointing out that gold has outperformed just about everything for the last 25 years. I first started buying it back in 2003 at about $280 an ounce. And for my clients, 280 to 330. It's been the longest, most boring bull market, but here we are.
Well, I do concur with you. For diversification purposes, it's been a great hedging, especially against volatility. And for obvious reasons, gold has had a great run in theory in 24, simply based on one global phenomenon that BRIC countries have been trying to accumulate more of it to put up some fight against US dollar, and the US being the reserve currency. But is that likely going to continue? I think you already said you're pretty bullish on gold, still bullish. Although I saw, again, for what it's worth, right? There was a projection, I can't remember, was it Goldman Sachs or JP Morgan? It was when the gold was around 2,900, maybe a little over 2,900. And they were projecting by the end of the year it'd be at 3,100. I mean, it's bullish, but it's not like, you've had such a great run, you're going to go up another 5, 6, 7%. It's not another massive home run. And then
it's actually comical, to be honest. They show up at 2,900 and say we think it could go to 3,100. Where were they when it was at 1,100 a few years ago? We see BlackRock saying the same thing. I mean, this is just laughably pointless. Insights from Wall Street. BlackRock suggesting that coming out at the election right around the middle of January and saying yes, that everyone should own 2 to 3% of their portfolio in Bitcoin at 100,000.
It
makes sense.
Gold.
No, Bitcoin. And the literal quote from BlackRock was 2 to 3% makes sense for investors here. Where were they when Bitcoin was trading at 6 cents a block or 1,000? Nope, they show up at 100,000.
Well, they must be marketing something, right? They
exact top tick. Yeah, it's just laughable. Goldman's, oh goodness, there could be an extra, we get to 3,100. Oh, an extra 3% from here. What are you talking about? It's pointless. This is not a forecast. This is just bandwagon jumping. But it's what they do. And exactly as you say, they do this so they can offload their holdings that they've had for, the run in Bitcoin from 20,000 to 100.
Yeah, it's fascinating. The Wall Street, as you said, it's the immoral monster machine that influences large amounts of capital, and they need to keep the management fees, keep the dollars in their ecosystem. So if the markets are fluctuating, they need to push something else. And well, I don't want to spend much time on crypto other than Warren Buffett said he wouldn't pay $25 for all the Bitcoin in the world, and I have plenty of friends who have significant positions in crypto, and I have to say that it's been, for a lot of people, it's emotional. I mean, they believe it's hard for them to take action. You're truly a disciplined trader. A lot of folks have held on to crypto because it has done well. It's exactly, the trend has been their friend. But the crazy part, these conversations do take place. I have so much in crypto, I could retire many times over. I literally had a discussion with an investor a couple of months ago. He called me that, what do you got in real estate? You got any great deals? And I told him about the deal that we did, a 9 cap on multifamily. Insanely good deal based on fundamentals. And I have to say that he sold some crypto and put some money there. I'm pretty sure he's happy with the investment. But what's going to happen with the Bitcoin and Ethereum? What do you think? I mean, we're going to see more volatility related to the fact that it's a highly volatile. What do you call it? It's not even digital currency. It's a digital commodity. How do you look at even crypto? How do you call it?
I think it's a phenomenal manifestation of a late cycle cheap money euphoria. That's what it is. I mean, we've really, Dave Rosenberg did some great work on this, basically what human behavior has attended the last economic shift since 2020 and COVID, and where we dedicate our time. The number of people that are sitting at home, previously PPP for business owners with free money, it's the ERC credits. It's worth pointing out just how despicable this is, and evidence that morality is accidental in politics. It's never, it's not a feature. Is the employee retention credits as a dollar figure peaked in July of 2023, meaning more money was paid out in July of 2023, fully 2 years after we had stopped mandating masks and so forth, when unemployment was sitting at 3.6%. So we had record low unemployment already, tight labor markets. Myself, I've got multiple businesses with employees. All of my clients have businesses with employees, and yet still getting paid by the government to keep employees on when we were struggling to find more of them, more qualified. So what happens? All of this money pours into the system. You've got massive stimulus programs, cheap money, but for business owners, and unemployment benefits being doubled in many cases. All kinds of rampant unemployment fraud practices. Individuals are paid and induced to sit home and speculate. And I think that's really what captures this. You know, the issue for me is, while it's great that people have quote unquote made money on Bitcoin, or whatever it might be, that's wonderful. The question becomes, if you bought it because most people have suddenly become kind of they become fiat money, fiat dollar, historians, and everyone's suddenly an expert on fractional reserve banking and so forth. These are just justifications to make what are really emotional decisions and buying them. And we all do this. There's no judgment. But if you had such an esoteric, ethereal reason to buy something, what's going to be the reason that you ever sell it? Given that we have no valuation for it, we can't say when it gets to this multiple, or when it generates this, when the dividend collapses, or when revenue increase. It's not an asset that we can really quantify its value, except that it's self-referential by the very mania that's supporting it. So, when will people realize those losses? What will it take to do so? I have no interest in that. I can't identify where I would get out.
Yeah, that's great wisdom. You're a fundamental value investor. Fundamental value investors really struggle with assets like this because you can't establish fundamental value. It's just very difficult.
Yes.
It's the tulips. As long as somebody else is willing to pay a greater price, everything is good until it's not. And when does it stop? Who knows? But back to 2025, 24, the U.S. led the world. Is 25 U.S. going to continue to be one of the leaders in the world, or with Trumponomics, we're going to create, like you said, a lot of disruptions around the world, a lot of uncertainty. Are we still going to be stronger than everyone else? Are we going to be successful at driving America first, bringing in domestic manufacturing, production, less trade, implementations of tariffs to support domestic production? I'm just curious, kind of what do you see sort of next for the United States? I know we're kind of a little bit short on time. Maybe we'll go through Q&A, but final thoughts there, and then Diana chime in with any Q&A, any questions sitting in the comments.
I think that well, first of all, on tariffs, the great French economist and philosopher Frédéric Bastiat said, "When goods don't cross borders, soldiers do." And there's wisdom here. He was very much a laissez-faire type thinker. There's so many overlaps, such an overlap between where we are today politically, price-wise, valuation-wise, and so forth, to where we were with another president in the past. I want to just say one thing about tariffs. Well, first of all, just to point out, if I can, for a minute, and again, this could, if politicians are your deities, then you won't like what I'm going to say. But if they're not, if you are, as I am, agnostic about, I don't expect, I've never, coming from the third world, I know better than to expect a politician to take me to the Holy Land of, my blissful future. You have the same history, Mike. I don't think that you're holding out for anyone to save you either, because of your past, in a different culture as I am. In 1928, Herbert Hoover was elected to office with an overwhelming amount of support from the voters. He came in with a mandate to shift away from the loose laissez-faire economic environment of the roaring 20s, 1928, and instead start prioritizing American capital systems. Essentially, it was America First 1.0. Then, like now, he came into office at record valuations with a grossly overpriced stock market that had been in a ripping bull market for the prior almost decade. Then, like now, he decided, he brought in as his right-hand person, Andrew Mellon of Carnegie Mellon, of Mellon Bank, of the Mellon Fortune, of the Mellon business partner of JP Morgan's. Andrew Mellon was one of the wealthiest humans on the planet, and he came in as his Secretary of Commerce. then, like now, his right-hand wealthy advisor was advocating for essentially, as he said, liquidate the banks, liquidate the farms, liquidate labor. America needs a hard reset. Then, like now, Hoover was a known obnoxious deal maker. He didn't care what anyone said. He was going to do what he did. He was known to be very difficult engaging with his cabinet. His cabinet routinely said that they couldn't negotiate with him. He wasn't going to listen. Then, like now, he instituted a number of aggressive tariffs, which gave a tailwind to two particular senators named Smoot and Hawley that rolled out the Smoot-Hawley Act of 1930. It was proposed in 1929. Then, like now, his initial actions triggered a recession. Smoot-Hawley turned that recession effectively into a depression because it became a global trade arms race. I'm not saying that we're facing a depression, but the overlap is just uncanny. If we ask ourselves what is the objective here, we have to be careful because there's a point of diminishing returns to everything. There's one martini is great, three, you probably overdid it. One speculation, fine. Everything speculated, you probably overdid it, et cetera, et cetera. Point of diminishing return shows up everywhere. It's worth recalling that tariffs don't make the rich poor. They don't stop people from getting rich. They stop the poor from becoming rich. Tax increases and international trade conflicts, heightened regulatory environment, don't redistribute taxes. They redistribute taxpayers. Taxpayers start shifting to Puerto Rico, offshore deals, buying the second home to start locking in their assets, etc. So this is an important thing. It's not going to speak to the base the way that the base really wants to be spoken to. But the average US citizen is unaware of the long-term implications of international trade wars because they've never lived through one. And they kind of couldn't be bothered to sit down and do the reading, as our teachers and professors used to say. It doesn't stop people from being wealthy. It stops people from becoming wealthy because it essentially becomes a heightened tax for the average working American. When you stack that on top of already a strong protracted inflationary cycle that we're in, you stack that onto a record low home ownership affordability issue. It's a very dangerous political cocktail.
Thank you, Alastair. The wisdoms are just so profound. This comparison to Hoover administration is obviously concerning. That the Trumponomics don't really over pushes, like you said. One drink is good, but will he stop? Will he settle things down and calm things down, or he'll over push and God forbid we see another version of a great recession? And that commentary on the FHA affordability of single family housing is sort of at historic lows. And if there are further problems that hit the market, it could be really detrimental for residential real estate. Residential real estate hasn't really seen a correction the way commercial has, because supply has been very limited. But if new supply comes into play, and then we get some increased unemployment, a real recession, right? That there may be a meaningful adjustment in the residential. So again, I'm just listening to you and sort of trying to hear what you're saying. And in some ways, I'm a little bit optimistic that the Fed has very low tolerance for pain. If they start seeing very diminishing data, they wake up relatively fast and then they start acting. So I'll stop. Any more comments? And then Diana, any more questions that are in the...
Yeah, I have several. There's it's hard to know where to start. Basically, let's, I guess, run through these as quickly as we can to be thankful of your time for answering these. Some of them might be a little repetitive. So the first one is, how are liquidity conditions affecting private credit markets?
This might be one of the most important questions we can ask ourselves. To the extent that we continue to see layoffs in government jobs, which is historically the job you get and you never lose unless you die. So government employees are finally starting to experience what we in the private sector have lived with our whole lives. That will be when we to this, Geoffrey, there's so many pieces to this question. It's such a great question. I think that private credit is in serious trouble, except in the hands of the most qualified. And how will we know that they're qualified? If we look at a company like Prospect Capital, now making the news, there's an article in Bloomberg that's worth the review. Prospect Capital, run by a guy named Barry, I think it's Harry, last name, sounds like an obnoxious guy, essentially was one of the first people in the game to take private credit to the public markets at scale. Prospect Capital is down 77% from its highs. The stock is trading in the low single digits. This is how far out we are in the bubble of private credit. PIK loans, payment in kind. When I was a kid, I was sitting in my dad's office. I always used to try to absorb whatever I could, learning from my dad, who's such a successful and wise businessman, and still is. I had this employee named Stanley, who was like the family joke because he was both the most endearing employee you could ever have and guy, but also smart as a box of hammers. Stanley was constantly living beyond his means and always asking my dad for money as an employee of his. One particular occasion, I was sitting in the room and Stanley owed him what it was $3,000. And my dad said, "Look, it's payroll. I want to pay you, but you owe me this money and you haven't made payments for a number of months." So Stanley thought about it for a second and he says, now again, I'm like 10, 12, I forget exactly how old I was. And he said, "Well, can I borrow $1,000 from you?" And my dad said, "Well, I just told you that I lent you 3,000." He says, "No, but here's what I'm going to do. You give me $1,000 and I'll pay you back. That'll reduce my bill to 2,000 and at least I've made progress." Of course, what I've just described sounds absolutely ridiculous, but what I've just described is one of the fastest growing sectors of the private credit market in the last 5 years, which is payment in kind, essentially using your credit card to pay your credit card bill. Coming back to Prospect Capital's P&L and their end of year financials show that they identify 26% of their quote income for 2024 came in the form of payment in kind revenue. Now, what we're saying is a company is owed money and the lack of a payment stacking up on that balance sheet debt on their balance sheet is being counted as income. This is astounding. So then we say to ourselves, they're lending companies to smaller mid-tier businesses, largely mid-tier businesses, who are in an environment of record asset prices, record home prices, strong currency, lowest unemployment, consistently lowest unemployment since the 1950s, consumer appetites that have gorged themselves on everything. If these businesses cannot make payments now, if they're struggling now, when do the good days arrive? When do the good? This is remarkable.
So quick follow-up question. So as liquidity shrinks, the private credit takes a beating. That's the most basic conclusion, and we're already seeing a ton of pressure and which you described, paying in kind, borrowing from a new source to just pay off the other source just to keep things afloat. That kicks the can down the road until you can no longer kick the can down the road. So we're hearing danger zone in the private credit, even though it's been very popular, but it sounds like great care is needed today, even in the private credit, with the market conditions shifting.
Yes, and private equity is about to face its first legitimate bear market since it really came into formation in the 1980s. Private equity, I've been dealing with them personally. I've sold a business to them. Well, most of my clients that I advise have had some version of many of them in exit. Private equity is sitting atop a bubble for the ages in illiquid, unknown assets that are privately traded with no identifiable valuation measures. And really, really convoluted corporate structures that allow them to gorge themselves on debt and pass the payments off to the business owners. This is a big deal.
Yeah, I appreciate that. I have a next question again. Diana's Zoom keeps crashing, so she just actually sent me a message. I'm going to read it. Are there specific regions or asset classes that are benefiting from the current market conditions?
Volatility is certainly doing well for me. That's a shorter term opportunity. As we touched on, gold and silver miners still have a lot of opportunity. Of course, real estate has to be selectively done in qualified hands. And I know, Mike, that's your area of expertise, is identifying those opportunities. You're better qualified to speak to those. On a global scale, emerging markets, Latin America, ILF, I think, is forming a major bottom. Emerging markets, EEM, just as proxies, and China. I'm also, the more speculative end of my holdings are Chinese internet companies and technology companies, which have been bludgeoned. These are all very, very exciting opportunities over the next decade. Now, if we do find ourselves in an asset deflation where markets and debt markets and so forth continue to contract, everything will go down. My sense is that, and so far it's been true, that those emerging markets that I've just explained will still weather the storm way better than anybody and still have better long-term prospects over the next 10 years for the reasons we discussed.
Thank you for sharing. A few more questions. Again, your insights are so remarkable. Next one. How are our new immigration policies expected to impact real estate demand?
Yeah, unfortunately, the immigration lax enforcement of the last several years has really abused the standard immigration protocol. As somebody that immigrated to the United States, it took years to get here. I have a younger sister who is just coming up now on her interview, the final leg for her interview to possibly come to the United States. And that was now been 16 years. For 16 years, we've been filing tax returns, applications, follow-ups. So I guess what I'm getting at is what type of immigration. If it's the kind of immigration we've seen in the last 4 years, that has done nothing but added a drag on the average taxpayer and debt burdens of the federal, local, and state governments. It's not helped us at all. Luxury hotels in New York, paid for by taxpayers, non-additive. Incentivizing people with free cell phones and free money, destructive to appetite and demand for single-family homes. So this is one thing I want to be clear about. I have no measurable way of knowing or no qualified opinion about what this immigration, we know what they're doing to purge illegal immigrants. What I don't know is what they're going to change to invite individuals that have job offers that want to be tax-paying, contributing citizens like my sister, as an example. So I'm afraid I don't know. But the purging of the excess is purging of the illegals. Their arrival didn't help. I don't know if their departure maybe will. I'm not sure.
Yeah, that's something that we talked about this quite a bit. You told me about your sister's story, and it is, being an immigrant too and going through legal channels. We need more of legal immigration, especially folks that come with education, like your sister, who's a doctor. All that is that's how America sort of has continued to grow, given low birth rate. Right? This is a dire need, but the undocumented illegal immigration, like you're saying, it has caused a lot of grief, but it hasn't really solved the issues for the labor growth. Maybe for some farming and really low cost jobs, but it also brought fentanyl and other problems. So that's great commentary. Next one. With tariffs and trade agreements shifting, which industries are
Or market.
go ahead, Diana.
Which industries or markets stand to benefit or suffer the most?
In the short term, everybody suffers, much like the old adage of a bear market. A bear market, everybody loses. The winner is the one who loses the least. So in the short term, I think it's likely to affect everybody. Disproportionately, it may also affect those very countries that I'm bullish on: Brazil, Latin America, etc., because they're net exporters of commodities to the United States. However, they've had the goodness beaten out of them for the last multiple years. They've got good cash reserves, and they can weather the storm better than the average American investor can, with low savings rates and extended leverage. So I'm afraid that there's long-term, there's continuing opportunities are presenting themselves in emerging markets and physical assets of emerging markets. Banks in Singapore, banks in Hong Kong will be recipients of those capital flows that are trading at tremendous discounts right now. Banks in Latin America will benefit from that. I started 6 years ago making the case that Miami is going to become this international global hub again. Now, 5-6 years later, that's clearly the case. But Miami, too, is grossly overbuilt, and their offices and high-end condo market is absolutely priced to decline. So a bit of a roundabout answer there, because it will be a while before we will feel excited about buying these things because of the short-term uncertainty around tariff wars. Right now, it's largely Europe, Mexico, and Canada. Is it going to extend to the Latin American economies? If it is, that could be challenging for them.
Yeah,
Wow.
it's a great wisdom. Go ahead, Diana. Next question.
Last one, unless there's any more in the chat. How should investors think about portfolio diversification in this market?
As I've probably revealed by now, I'm nationally agnostic. So I am not, to the extent that the country will enforce the rule of law. Again, we've had a problem with that ourselves recently, and even historically. Gold was illegal to own in 1936. So we've had our own overreach of legislative manipulation in the past. But to the extent that it's a liquid market that has some transparency, I'm a fan of all of the countries, and I'm a fan of shifting to a more global approach. We haven't really been rewarded for that for the last 15 years. The US and the US dollar has been the biggest game in town. I believe that larger trend has bottomed, and we're now moving into an era of falling US dollar. I think that the dollar is possibly peaked, or it's peaking. And outside of the short-term gyrations in equity markets and capital flows and long bond, I think that the dollar is going to enter a multi-year bear market, probably getting back down to the the mid 90s from where it sits today, the dollar index, which is going to be positive for the yuan or the renminbi and the yen. So I think some currency diversification, gold, all of these depressed equity markets that are just crying out to be bought. As just mentioned, Hong Kong, for example, a 6 or 7% dividend at a price to earnings of 5, and this is astounding compared to where we are. And yes, there's political risk, but a lot of that is overblown. I hope that's not too roundabout an answer. I just think more than anything, capital preservation is more important now than it has been. And we need to be very measured about what qualifies for our money going forward. The areas that I've touched on, I think, are long-term huge opportunities. Everywhere's going to be tricky for the next 6 to 18 months. I'm pretty confident about that. At
Yeah.
least we're finally being rewarded to sit on T-bills and cash.
Well, I just want to encourage people. This has been a really good discussion, and Alastair is actually joining us for what I'm calling the 411 next month's Lunch and Learn. And I realize this is just Alastair's opinions. So I want to encourage you to join us for the next Lunch and Learn so we can hear other people and what they're thinking as well. You know, we're all just theorizing here. And so there's a lot of data to back up a lot of different opinions. So keep that in mind as you move forward in this economy and all the things that you're doing in life. But definitely join us and stay informed on our next Lunch and Learn. And I really want to thank you, Alastair, for being here today and for answering all of these questions. I know that it's a tough world right now to really know what's right or wrong. And so we really appreciate your opinions and thoughts on things and all of the knowledge that you bring to this discussion. And I'm so excited to host you again next month. And thank you for all your time today.
Thank you, Deanna. Your point is absolutely right on. These are all just opinions that we have, that we've come to for whatever our motivations might be. And I'm looking forward to hearing strong alternatives. You know, I don't want to be wrong for a minute longer than I have to be. So I'm looking forward to that as well.
Thank you.
Thank you, Alastair. I'll add one more comment. So that discussion in April will be awesome because we're going to get many other commercial real estate industry leaders with their own strategies. And you'll hear about self-storage, industrial, or open air shopping, multifamily, some of the brightest minds in the country. So, and I want to come back to the Warren Buffett. We mentioned Warren a few times, and I really love this thought process. Never bet against America. Warren Buffett continued to believe in America. I too, and there may be better opportunities around the world based on relative value, as you mentioned. And it's for folks to evaluate, talk with their financial advisors, of course. But personally, I still love America, and with all the challenges and difficulties of our political system. Growing up in the former Soviet Union, I have to say this is still way better. We're not perfect. We have our challenges, but I have to still give America a lot of credit and love because in many other parts of the world, the political and economic system is far more difficult than the United States. So I would never bet against America, at least not in my lifetime. And even there are better opportunities, it's different. But for some folks who are global, can continue to diversify outside the United States, I still feel we have a ton of great opportunities here. And certainly, folks should continue to believe and invest in America.
Couldn't agree with you more.
Well,
Thank
thanks,
you.
everyone. I
Thank
hope
you
you have
all.
a great weekend.
Thank you both.
All right, take care.
Take care.